an economist with Edelweiss Research, and I'm glad to present to you the third episode in the series, The Calm Allocators. Debt as an asset class attracts the most value of investments across the globe, but is relatively less talked about. It has gained its fair share of limelight amidst the crisis. It is relatively low risk and low volatile. The sound of safety amidst a global crisis sounds like such a relief to the investors. And as we speak today, we have zero interest rates in the advanced markets, and globally, a large USD 16 trillion worth of debt that is yielding negative rates. To add to it, India's markets are severely underpenetrated, and there's a possibility of a whole lot of advancements. One such innovative product was Bharat Bond, the first debt ETF in India, which was launched in December 2019. In conversation with us today is Radhika Gupta, MD and CEO of Edelweiss AMC. She definitely needs no formal introduction, but if I were to choose a word, I would call her inspiring. We are constantly inspired and learning from her life experiences, her hard work, and her zeal for life. Not to forget her storytelling skills. So Radhika, a very warm welcome on the show.
Thank you so much.
So Radhika, United States has seen a 35-year-old positive returns in fixed income, what is referred to as a long-term debt cycle. Do you think a similar story could play out in India?
Well, we have already actually, whether it is going to play out, I think a large part of the fixed income bull market has played out. The last year, if you look at it for fixed income funds outside the credit category, has been a very, very good one. We've seen interest rates fall from levels as high as 8 to closer to 6. And if the question is whether interest rates will fall further, we are definitely on the lower end of the cycle. But given the extraordinary economic conditions posed by COVID and the unique circumstances that there are today, I do believe that there may be room to cut rates further, or at least keep rates at low levels, because this is a time when countries all over the world are keeping interest rates low to stimulate growth back. The US has seen this now, and the US also saw this in the 40s, incidentally. And it would not be surprising to see sustained levels of low interest rates in India. That said, in the Indian context, I think a few things are different. There have been significant number of rate cuts by the RBI, but if you look at it, the real pass down impact has been towards the shorter end of the interest rate cycle. So 1, 2 year, 3 year rates have fallen a lot in the last 6 months, for instance, but 10 and 5 year rates have actually not fallen that much. So what we call the yield curve has actually steepened substantially. So that's one thing to keep in mind. Secondly, the spreads are also, from an investor point of view, moving differently. So while government bonds, the pass down has happened completely, in corporate bonds, even AAA public sector bonds, the spreads relative to government bonds still remain elevated and still remain at sort of the higher end of the historical side. On one side, you have the government of India and companies borrowing at 3-4%. Then you have the public sector borrowing at maybe 1% more. And then you have companies borrowing at significantly higher levels. So in India, I think the situation has been different. Rates are coming down. They have come down, could come down further. But the transmission to the higher end of the curve and the transmission to some other segments in the borrowing have yet to happen completely. And I think that is what is more important. And that is what the Reserve Bank will be looking at, and regulators and, the Finance Ministry will also be looking at going forward.
Thanks, Radhika. So as you said, that the yield curve has steepened, and I think Reserve Bank has launched these operation twists where they are trying to reverse this. So they're trying to bring the whole curve down, but also specifically bring the longer end down. So as we know, there are two tranches of Bharat Bond series. One is, I think, 2025 series, and the other is 2031 that is scheduled to be launched in July. So what is your view on how it can be a favorable interest rate play? And secondly, since Bharat Bond, it invests in PSU enterprises. So it's not really just like interest rate plays, let's say like for gilt funds, it also will play on compression of spreads. And the spreads between PSU yields and GSEC yields have come off a bit lately. But how much do you see there's a scope for this to soften further? And what should be the realistic investment return that one could look from the Bharat bond debt investments?
So yes, Bharat Bond comes up with two new tranches, 2025 and 2031. So the 2025 is a 5-year product. The 2031 is a 10.5-year product. This follows the two existing tranches that were 2023 and 2030. The rationale for coming up with these two, I think, is a reflection of the first comment I made. If you look at where spreads are attractive for investors today, we do believe it is on the medium to long end of the curve rather than the short end where the interest rate compression has happened. If you look at the 3-year, which is a common segment that people invest in today, AAA PSU spreads, depending on the day, somewhere are probably in the 5.3 odd range. But if you just go 2 years out on the curve, you're probably getting about 60 basis points more, 60 to 70 basis points more. That, in my view, then becomes a really nice case for the 5-year product, which I think even in the roadshows is attracting a lot of interest. Because if you want to park medium-term money, you're getting that substantially higher spread. 10-year rates have remained elevated. The first tranche saw this. The second tranche also, I think rates will remain in the 6.7 to 6.9 kind of vicinity. And again, that becomes attractive. As I said, in the 10-year segment in particular, there is a story about term structure compression. You already saw that with the first series of Bharat Bond. There's also a spread relative to G-Secs of about 80 to 90 basis points. So I think that makes it an interesting time. I would say Bharat Bond as an investor case has multiple uses. Its first design was for hold to maturity investors looking to invest for 5 years, looking to invest for 3 years. And because it's a roll down or target maturity structure, if you are invested for the tenure of the fund, you're likely to realize something close to the YTM. So I think that is the most important use case. And because it's AAA PSU, you have the comfort of credit. Now, there are some people also that choose to do it now because they want to play the spread compression story or the term structure compression story. So they do the 10-year and then they exit in 3 years after capital gains. That is a second use case if you want to play that story. But I think the important use case is also the hold to maturity one. That is something you don't get in gilt funds. So when people invest in gilt funds, they are taking explicit duration risk. That you don't have to worry about in Bharat Bond. You want to play duration, you can, but you have a very clear hold to maturity case also.
Okay, Radhika, so that's insightful. So basically, unlike the gilt fund, we can also minimize the interest rate risks if we decide to hold to maturity. And there's obviously a case to play for spread compression and the term compression. So Radhika, this is my very, very layman understanding. Basically, if inflation is low, yields are likely to be lower. So I would make some capital gains. But if inflation is higher, then the indexation benefits would at least guarantee a lower tax rate for me. Now, these synergies with inflation are difficult to account for in other asset classes. Therefore, like in the longer term, how much do you think investing in such an instrument can affect my returns versus, let's say, traditional equity investment?
So I don't think you should compare debt and equity. I think the way to look at it is with something like Bharat Bond is your average rate of inflation, to your point, is about 4% a year. You can assume 3, you can assume 4. I like to assume 4. So pick the math you want to pick. Now, if you're doing the upcoming 2025, that's at about 5.7, 5.8, that kind of ballpark, then 5.8 minus 4, that's 1.8 on which you'll pay 20% tax. So that's about 36 basis points of tax. So you're still sitting at about 5.2, 5.3% on a post-tax basis for 5 years. In my view, that is a very good number. I don't think debt assets and debt investing should be compared to equity investing. I think they are distinct in both important parts of your asset allocation. So you should complete them independently. I do believe something like this, however, has a good core portfolio role in your asset allocation. I would also say that, remember, now there's a series of Bharat bonds and more of these will come out. 2023, 25, 2010, 2030, 2031. And you can actually build your portfolio depending on when you need money. So if you have some 5-year money, some 10-year money, some 7-year money, some 2-year money, you can build a full portfolio of these products using Bharat Bond that end up becoming very efficient on a post-tax basis. They spread also to something like tax-free, I think is about 80 to 100 basis points also. So that's another case for looking at something like this, tax-free of the same issuers.
Okay, so that's great. I mean, you've already answered my next question that for retail investors, on-time liquidity is very important. Bharat Bond is the first debt ETF. It also trades as a mutual fund. So it's possible to redeem it whenever. But on a scale of liquidity, basically how liquid it is on exchanges and otherwise, and in terms of exit loads, how would you relatively rate the current Bharat Bond structure?
So let me just explain the two investment options and then we'll cover liquidity in both. It's a good question. So the ETF is a virtually zero fee product, 0.0005 in fees with no exit loads. To buy the ETF, you need to buy it via your demat account through a broker on the exchange. And we have appointed market makers on the exchange to provide liquidity. There are some investors who choose not to have demat accounts or do not want to trade on the exchange. They find that process onerous or whatever it is. For them, we have created a vehicle called a fund of funds vehicle, which has been very popular actually with investors. The fund of funds just buys the ETF and it's like buying a regular mutual fund. So you have both options as an investor. If you want to do it on the exchange, you can do it on the exchange. If you want to do it on the fund of funds, that is also very marginally costed at 5 basis points. And it has a small exit load just under a month. So it's a very token exit load just to make sure there's not too much in and out. So you have the ETF option, you have the fund of funds option. Liquidity, in the fund of funds option, it's just like redeeming in a mutual fund. In the ETF, you have to sell on the exchange. I must tell you, in the first tranche, we've seen very good liquidity conditions, about 4 to 5 crores of daily trading volume in both of these versus 1 to lakhs in the GSEC ETF. So liquidity has been much better. Above 25 crore investors can come to us directly, but below 25 crores, because the market makers have been present on the exchange, I don't think investors have had any challenges so far on liquidity. We've also had in this period, and this has been a period of heightened debt market volatility, lower liquidity conditions, and shorter trading hours, but we've still been able to process subscriptions and redemptions of as large as 500 crores on some given days, and we've been able to process them very comfortably. So we haven't seen a challenge in liquidity here because the portfolio is built that way, and you are talking about AAA PSU bonds, which are the most liquid segment of the debt market today.
Okay. All right. Thanks, Radhika. So that's very insightful and relieving for the retail investors specifically, because liquidity becomes very big judgment for our investments. And secondly, as you said, there will be more and more tranches across maturities that will be coming out shortly. So we can always choose wherein we want to invest. Okay, Radhika, before I conclude this, I have very well noted your point that debt and equity investments should not be compared, and the fact that debt offers has a very core space in our portfolio. It gives us the margin of safety that we all crave for. And I mean, let's take a moment to accept that we are amidst all sorts of turmoil currently. It's medical, financial, as well as the emotional crisis that's going around us. Given that the news inflow has been very negative, it has turned positive now, and we hope it will last. But among the dislocations that 2020 has seen, especially in the debt markets in the month of April, what is your final remark on investing discipline in such times?
I think I would say a few things, and I'll keep this specific to debt. See, this is a time to be calm and this is a time to be patient. And it's also not a time to take rushed decisions. Now, in the context of debt, I'll just give you 2-3 pieces of advice that I would leave you with. One is that debt is a safety asset class, and don't try to compromise safety. It is always focus on capital first and then on returns. The safety and liquidity come before returns in debt. If you want to take serious risk, I suggest you look at equity. Secondly, we are in a lower interest rate environment, and it is difficult for us as Indians to accept lower interest rates when you are used to, your mind is anchored to 7 and 8%. So you see numbers like 3, 4, 5%. Do not make the mistake of stretching for more and taking risks for that 1% more in this kind of time. I'm already seeing signs of it, and that worries me. So I wouldn't do that. Thirdly, keep your debt investing simple. I try to divide my money honestly into 3 parts in debt investing and just stick to that. I put my very short-term money, that is under 3-month money, into liquid and overnight funds. I put my money between 3 months and 3 years into arbitrage funds, which are tax efficient. And above 3 years, I like to use Bharat Bond-like structures. high safety, high degree of liquidity, no worry about interest rates. And depending on my time horizon, I just match it. So keep your approach to debt safety focused. Don't reach for extra high yield and just stick to the basics and you should be fine.
All right, Radhika, on that note, I think we have a very important advice to take from you, that this is the time to stay calm and patient. This is the time to value peace of mind. There's enough turmoil around us anyway. We'd rather go for margin of safety than higher and riskier returns. So thank you so much for being on the show. And for our viewers, I think the rationale is to be able to think calmly as we face this turmoil and as we navigate through the crisis. So thank you so much for joining in.